All right, welcome to The Explainer. So, you ever think about how massive companies make those huge decisions? Like, should we build this new factory or should we launch this brand new product? Well, it's definitely not as simple as a yes or no. Today, we're going to crack open the toolkit that financial managers use to see past just a single number and really truly get a handle on the risks and rewards of these giant projects.
I love this quote from T.S. Eliot because it just hits the nail on the head when it comes to project evaluation. It's not about searching for that one magic, perfect answer. Nope, it's all about exploring tons of different possibilities, making revisions, and really thinking things through so you can make a smart, informed choice.
Okay, so picture this. You run all the numbers for a new project, and boom, you get a positive net present value, or NPV. Your first thought is probably, awesome, green light, let's go, right? And this is a huge but, that one number, well, it's just the start of the story. It's not the final chapter. Think of it like a signpost telling you you're on the right road, but it's not the final destination.
The single biggest challenge we're up against here is something called forecasting risk, and it's exactly what it sounds like. It's the very real danger that all our guesses about the future, our estimates for sales, for costs, are just plain wrong. And if we get that wrong, a project that looked like a sure winner can turn into an incredibly expensive mistake, fast.
So, every analysis has to start somewhere, right? We call that starting point the base case. It's basically our best guess, our most likely, realistic scenario for what's going to happen. Now, for the example we'll be using, the Wetway sailboat project, the base case gives us a positive NPV of about $88,000. And hey, on the surface, that looks pretty good. But the big question is, what happens if our best guess isn't so good after all?
Okay, so how do we actually put that base case number to the test? How do we kick the tires on it? Well, the first tool we pull out of our toolkit is something called what-if analysis. And really, it's just a fancy way of asking a bunch of questions to see the whole range of what could happen.
This is where things get really interesting. Take a look at this. This is scenario analysis. We cook up a best case, where everything goes perfectly, and a worst case, where it's just one disaster after another. Now look at those NPV numbers. Just look at them. They swing from a profit of over $500,000 all the way down to a loss of almost $250,000. That is an absolutely massive range. And what that's screaming at us is that this project, it's got some serious risk baked into it.
Now, scenario analysis is super useful, but it's kind of like a sledgehammer. It changes everything all at once. To get a bit more surgical, a bit more precise, we use something called sensitivity analysis. With this, we change just one thing at a time. We freeze all the other variables and we say, okay, what happens to our profit if only our unit sales change? It lets us see what really moves the needle.
And wow, this chart just lays it all out there. It perfectly shows the power of that one single variable. Look, when the only thing we change is the number of boats we sell, the NPV goes from being negative to almost $300,000 positive. That, my friends, is a giant red flag. It's telling us loud and clear that the success of this entire project pretty much lives or dies based on hitting those sales targets.
All right, let's grab our next tool. We're going to build on what we've learned. So instead of asking, what if, we're going to flip the question around. We're going to ask, okay, how bad can things get before we're actually in the red? This is the whole idea behind break-even analysis.
But before we dive in, let's do a super quick review of costs. There are two main types. First, you've got your fixed costs. These are the bills you have to pay no matter what, even if you don't sell a single thing. Think rent, salaries. Then you've got your variable costs. These are tied directly to production. The more sailboats you build, the more you spend on stuff like fiberglass. Getting this distinction is absolutely crucial for what's next.
So our first tipping point is what we call the accounting break-even. This is the number of sales you need for your official income statement to show a profit of exactly 0. For our sailboat project, that number is 60 boats a year. If we sell 59, well, on paper, we're officially losing money.
But here's the thing. You can lose money on paper and still survive for a while. The number that really matters for survival is the cash break-even. This is all about cash in versus cash out. It's the point where you're not making money, but you're not bleeding cash either. You're just treading water. For Wetway, that's way lower, only 25 boats. At 25 boats, we can keep the lights on, but we're not getting ahead.
Okay, and this is the big one. This is the most important number of all, the financial break-even. This is the number of sales we need to hit a 0 NPV. Now remember, a 0 NPV doesn't mean we're making $0, not at all. It means we're earning exactly the return our investors expect, in this case, 20%. Anything less, and we're not meeting their expectations. So for this project to actually create value for our company, we have to sell at a minimum 84 boats. That's the real hurdle.
All right, for our final tool, we're going to look deep inside the project, right into its financial DNA, if you will. We're going to examine its cost structure to really understand its built-in risk profile.
And this concept is called operating leverage. The best way to think about it is like this. A project with high fixed costs is like a souped-up race car. When you hit the gas, when sales are booming, man, your profits just explode. They accelerate like crazy. But that same powerful engine works against you if you have to slow down. If sales drop, your losses get magnified just as quickly. It's a classic double-edged sword, a measure of both risk and reward.
And you know what's cool? We can actually measure this with a specific number. It's called the degree of operating leverage, or DOL for short. For our Wetway project, the DOL works out to be 1.42. But what on earth does a number like 1.42 actually mean in the real world? Let's break it down. Here's what it means. It means that for every 10% jump in sales we get, our operating cash flow doesn't just go up by 10%. No way. It gets juiced up by that leverage, and it actually jumps by 14.2%. See? That's the 1.42 at work. It shows us that our cash flow is extra sensitive to any little change in sales.
Okay, so we've run the scenarios, we've found all our tipping points, we understand the project's leverage. After all of this work, how do we make the final call? How do we decide go or no go? Well, think about how far we've come from that single NPV number we started with. It's night and day. We now have this rich, complete picture of the project. We know the base case is a go, but we also know what the worst case looks like. We know exactly what drives our success, sales. We know the precise point of failure, and we understand the project's inherent risk. It's like we've upgraded from a single warning light to a full-blown dashboard. And just when you think you have it all figured out, there's one last, harsh reality we have to talk about: capital rationing. Here's the deal. A company can have 10, 20 amazing projects, all with positive NPVs, all looking like winners, but they might only have enough cash in the bank to fund 2 or 3 of them. It's a tough, real-world constraint that forces managers to make some incredibly difficult choices about which great ideas get a chance to live and which ones stay on the drawing board. So, what's the big takeaway from all this? It's that financial analysis is not about having a magic crystal ball. Nobody can perfectly predict the future. It's about doing your homework. It's about stress testing your ideas, understanding all the different ways things could play out, and knowing your biggest risks inside and out. The goal isn't to be right all the time. The goal is to be prepared, to be ready for whatever the future decides to throw at you.